Okay, do I start?
Welcome back, everyone, for Freelance Business Week. I am here with Marinia Hash with speaking about your state of your business and your financial story. She has so much to share. We've already had a great day of so many great speakers, and we still have more to come. Again, if you want to see or need replays or you missed somebody speaking, make sure you grab that all access ticket. Grab that today so that you have access to the previous from yesterday all the way up to the end of this week presentations. You get to watch them whenever you get the time to see it, but you need that all access pass. So make sure you grab that all access pass to get the replays. We are here again with Verenia Hash, speaking about your state of your business, talking about your financial stories. I'm going to pop off the screen so she can jump right in. Verenia Hash, the floor is yours.
Hello, everyone, and thank you for attending my workshop today. And today I am going to talk to you a little bit about what it really means when you hear the word accounting. I'm not trying to turn anybody into accountants, that's my job, but you need to know what are you looking at when you're looking at your financials and what others are seeing when they see your financials. So today I'm going to define accounting. I'm going to help you understand what your financial statements are saying. And if I can get to it, we're going to talk about your business owner's responsibility for taxes. So the first thing is, what is accounting? A lot of times when you hear the word accounting, you think of balance sheets, profit and loss, debits, credits, and other financial reports. But truth is, those are the outcomes of accounting. Accounting really is a systematic process of identifying, recording, measuring, classifying, verifying, summarizing, interpreting, and communicating financial information. It reveals profit or loss for a given period and the value and nature of the firm's assets, liabilities, and owner's equity. Yeah, right. Whatever that means, right? So let's break it down to something that could be a little bit more easier for you guys to understand. I'm a sports girl, so I like to define counting as a sporting event, a game. My favorite sport is football. And I'm from New Orleans. Hey, who that nation? So I think of accounting, when you go to a football game, you see what you have. You have teams. Teams are your employees, people you hire to help you within your business. You have coaches, you have the owners and the managers, people who help you implement your strategy, to communicate your strategy, your marketing to your team on how you're going to move forward with operating your business. You should also have is an offense. What is your plan? How do you plan to move your business forward, your offense? How are you going to defend yourself against your competition? How are you going to succeed over your opposition? You have the competition, because that's the other people in your industry, other people in your market segment. And then you have the score. Score is, what is that bottom line? Are you reaching that goal that you set? And then you have winners and losers. So going forward, to me, I say accounting is a scorecard that provides you with the following information. Is your strategy working? Are your teams and coaches understanding what your marketing plan is, what your strategy is, and are they implementing that strategy? And how are you performing against your competition in relation to them? Are you performing better? Are you performing worse? Do we need to make adjustments? Hey, it's halftime. Hey, time out. We need to pull this out. This is not working. Do I need to adjust who I have on my team? Give me new teams. Or is my coaches not working? Should I fire my coaches and move and advance my team members? Should I demote some coaches? Should I hire new team members? And what improvements do I need to be made? Do I need to buy better equipment? Do I need to move into a new facility? And are you accomplishing your goals? When you started your business, you had a goal. What is that goal? And are you on track to accomplishing that goal? Or do you need to make adjustments so that you can get to your end goal?
Real quick, Verenia,
Mm-hmm.
there's a scratching from your sound. So just adjust your mic so that it's not keep scratching.
Okay, hold on. Is that better?
Yes, much better. Thank you. Continue.
Okay. Okay, are you winning or losing? Once again, are you winning the game? At the end of the day, we're going to have winners and losers. Are you succeeding? You're going to be in business. COVID turned out to be a good indicator of who was winning and who was losing, because a lot of us did not make it. And if you are on this call and you're still in business, congratulations, you are winning. And let's continue that winning streak and keep it going. So, what are the financial statements? Financial statements are a written record of activity of your financial performance. It tells you how are you using the funds that was entrusted to you by blanks, stockholders, money that you invested into the business. Are you using the making the best use of those funds? So that's what your financial statements tell you. The basic financial statements are the balance sheet, your profit and loss statement, and a lot of people do not go this far. But if you're not, I'm suggesting you go this far going forward. The statement of cash flows. That information on that statement of cash flows is so instrumental in how your business is doing, and I will show you a little bit more about that as we move forward. So, the balance sheet. The balance sheet it displays your assets and how they're financed and to debt to equity. So it's a basically it's a snapshot of the company's assets at a given time. I like to say the balance sheet is like a video, because the balance sheet goes from the day you started your business through today. It tells how your business has performed over time. So you look at it as a video. And if we're going to go back to my sports game again, you're looking at the entire season of a team. So you're looking at all the games that they performed in that particular season. And the basic accounting states equation is assets equals liabilities over owners' equity or stockholders' equity. So what's listed on the balance sheet? Everything that the company owns: cash, the assets, cash, furniture, fixtures, land and equipment, receivables, prepaid expenses like insurance. If you pay your insurance up for the year, that's a prepaid expense that you would record throughout the year. And then patents, goodwills, and copyrights if you own any of those. And it also shows your liabilities. That could be any debts. That's the claim that a company or individual have on your assets. That would be your bills, accounts payable, your bills, expenses that you have not paid yet, taxes payable, income tax, sales tax, payroll tax, wages payable. Sometimes your your payroll period, half of it may be in one year, the next be in another year, half of it in another year. So that part that's in that first year, it's payable, and you have to record that liability on your books. And then you have, come on, notes payable. That's your loans, lines of credit. And then equity is what you have left after all debts have been paid by the company. So an example of owner equity are retained earnings, net income, common stock. Member stock is another one, members capital. A lot of us have LLCs, so we don't have common stock. So that would be the members equity, members draw, whatever it's called on your financial report. Then you have your income statement, also known as the profit and loss statement. It lists the revenues and expenses from operating and non-operating activities from a period of time. And it will I will give examples of what I mean by operating and non-operating expenses, but it just shows the company's net profit or loss. And like I said, most companies would stop here, but you're not getting the full story if you're just looking at your income statement and your profit and loss statement. You have to move forward. You have to go further. You got to dig deeper, because other folks that are reading your financial statements, they are digging deeper. They want to know more. So you need to know what they're seeing. So you got your statement of cash flows. It reports on the cash generated and spent during a specific period of time. So it acts as the bridge between the balance sheet and the profit and loss statement. It shows what I like to say, like sometimes when I see people and I talk to them, and I will ask someone, do you make a profit? And they will tell me yes. When I ask them how they may know they made a profit, they say, oh, I have cash in the bank. Well, no, you have cash flow. You can actually have cash in the bank and look like you have a lot of cash in the bank, but you have no profit. I've seen financials where the companies have a loss, but they have a cash in the bank. They have cash flow, they have no profit. You can have profit and no cash flow. So you have to look at that cash flow statement to get the true story of what's going on in your business. And the cash flow are broken down into three categories. The first one is the operating activities. Operating activities come, this number tells you how your business activities are doing. And this is where you want to show the strongest number, because it says that from my everyday operations, my current assets, which is your cash and your receivables, I can pay all my current liabilities, which is everything but debt, but loans and lines of credit. So that'll be your accounts payable, your income tax payable. Current liability means anything that is due within the next 12 months is a current liability. So any current assets you have, that's anything that is cash and can be quickly converted into cash that can be used to pay your current liabilities. The better this number, the stronger your business looks. It makes investors and banks happy, because then it says, oh, I'm going to be able to get my money back from this individual. The next thing is the investing activities. You don't want your cash flow to come from the majority of your cash flow to come from investing activities, because then it says your business cannot generate enough money to support itself. So if you're having to dispose of long-term assets to meet a debt, that does not look good to lenders and investors. So you want to make sure that your money is coming from your operation debts are paid from operating income and not from investing or the financing activities, which is when you go out and borrow money and go get and try to get capital infusions to manage your day-to-day operations. If you have to lean heavily on investing and financing activities, your business does not look solid. The state of your business is really weak to a lot of uh, investors and banks. So those are the three major financial statements that you should be reviewing with an accountant every month. Other reports I like to look at is the sales reports. Sales reports tell you how your business is doing when you are in a peak season and when you're in a low season. It helps you with managing those cash flows when you can look at those sales reports and predict how your trends are going, because business is a trend. My business alone, you have your tax preparation season. And during tax preparation season, everyone knows I am at my busiest, because that's when everybody comes to me and get their taxes filed. Well, most folks come to me and get their taxes filed. I file a lot of extensions too. But I know during that season, my revenues will be high because I have a lot of work coming my way. But it slows down after April. I'm still preparing tax returns, just not as many. So I have to and budget and plan for my lows on those days, on for those times of the month of the year where income is not coming in as fast. It's still coming, it's steady, but it's not as heavy as it is when I'm in my peak tax season. Budget to actual reports. Budgets are forecasts. It's telling you this is the plan I have in place for paying using my resources that are available to me. And you want to look at that budget and then look at what you actually done to see how good are you at that and what adjustments you need to make. Because a budget is nothing but a forecast. It's not set in stone. You can always tweak it, but it gives you great information on how you're doing, how you're treating, how your business is growing or not growing, and what adjustments you need to make. You need to be so those that report's important. Job profitability reports. Those of us who are project based, construction workers, sometimes accountants have projects. You want to look at that job profitability report. One, when you set that budget, when you set that put that bid out for that contract, you had an idea in mind how much you wanted to make on that project. So job profitability reports that you're looking at as you go along lets you know, one, if you are meeting those targets and what adjustments you have to make to spending to, if you're not, to make that part, make that reach your target, reach that goal that you set in place. Two, it lets you know if that pain in the ass client is really worth all the trouble they putting you through. And we all have them. That one client that see, sometimes I call them the vampire client. They're sucking you dry and they don't want to pay you for it. You want to know if it's worth it. That job profitability report will let you know, is this somebody who I want to keep or is this somebody who I need to get rid of? Sometimes, too, a lot of times we in business, we think if we get more customers, we'll just be where we are. Well, sometimes when you get more customers, you get more expenses. So you won't be where you are. Sometimes it's just a 10% increase across your sales, increasing your fees will get you where you need to be. And if you have really good customers and you're providing a great service, they'll pay that extra 10%. They'll look at that 10% as a bonus for the work that you do. Hey, why didn't you? I figured you would do this before. You did such good work. And then you don't have to worry about overburdening yourself with more customers and lowering the quality of your work. So this report will let you know, is there room for me to make adjustments in that way, or do I need to adjust my spending? The next report is the accounts receivable report. A lot of times we bill, we we collect right away. Sometimes we don't. And the accounts receivable report will let you know, do you have a customer that you're giving a lot of work to, doing a lot of work for, but they're not so fast to spending, and at some point I need to cut them off. And it also tells lenders and investors, how fast do you turn over your accounts receivable? If you look up and you got $1 million in sales, but you got 900,000 of them sitting in the receivables, yeah, that $1 million in sales look good on a profit and loss statement, but you haven't converted that to cash. So now now the lenders are going, if they got 900,000 in accounts receivable that they cannot collect on, how do they plan on paying me my money back? Because they're not collecting on their receivables. So you need to watch the receivables. They also want to know, are you paying your bills on time? So you shouldn't have, in those two reports, I say you shouldn't have anything over 30 days outstanding. Some days you may fall into 31, 35, but once you're approaching 60 to 90 days outstanding on receivables or payables, readers of the financial statements are looking at it and going, why? What's the problem here? So how do we analyze the financial report? So what do these numbers really mean? Readers of the financial statements are what they're looking to see is, how do they relate? They want to know if your company is stable. That's why I like to call this a state of your business, because if your company is stable, your reports will say that. And here are some of the reports, the numbers that they look at when they are looking at your financials. The liquidity ratio. That is basically, can you pay off current liabilities with current assets? And basically, what they do is take your current assets divided by your current liabilities and come up with a pretty number. The number, you want it to be positive and you want it to be as high as possible. If you have a current asset of 2, that means if you have a quick ratio of 2, that means you can take your current assets and pay your current liabilities 2 times over. That looks great to readers of the financial statements. This is a company I want to be more involved in. This is a company I want to work with, because they are they're using their resources wisely and growing their business. Um, the next one is the solvency ratio. These are your leverage ratios. Debt to equity. Funders do not like to see a lot of debt on the books, because if you have all this debt, what adding my debt, how is that going to help you? Is this going to make you more, more in more debt? And you need to figure out how to come out of debt. So me, you're not using the money that was loaned to you correctly in right now. So how I know it's going to be any different with my money? So they don't like to see a lot of debt on the books, the debt to equity. And if you remember when I told you guys earlier, the company has assets. The debt are the claims on that assets. So if all your assets were sold today, the debt gets paid off. Then any investors, if there's anything left, then the investors get paid. So investors want to see a lower debt because then that means if the business goes out tonight, out of I'm in. And debt don't want to see a lot of debt because where do they fall in line? They may get fractions on the dollar versus they whole dollar back if you have so much debt on your books and your assets are not enough to cover the liabilities. Equity ratio measures the amount of assets that are financed by owner investments. That just basically what it says. Equity is the owner's investments and how much of that is financed, how much of those assets were financed through your infusion of cash into the business, and how much of it came from you selling your goods and services to the public. And you don't want to see large infusions of cash from the owner in order to make the business survive. So you have to figure out how to organically grow that business without having to dig into your pocket so much. Because at the end of the day, you started this business you had a goal, you had a dream, and you're trying to make money. And if you're having to finance it in the beginning, of course, that's what startups do. But at some point, this dream should be feeding you, not draining you. The next solvency ratio is the debt ratio, which we talked about. We don't want that to be too high. It's the percentage of your uh, financing that comes through debt versus equity or operations. And a lot of times in the equity section too is retained earnings. So your net income rolls up into the equity section of the financial statements. And then you have the asset turnover ratio. That tells them how many times the accounts receivable turnover ratio. I'm sorry. That tells them how many times do you convert your accounts receivable into income. So as I said before, if you have $1 million in sales, yay, we sold $1 million worth of product, yay. But if 900,000 of it is sitting in accounts receivable, you don't have cash flow. You don't have the cash to finance the next $1 million in sales. They're looking at that. How long does it take for you to turn? And they actually have a ratio that says days of assets turnover. And there's the inventory. That measures how efficiently a company controls its merchandise. How fast do you get it in and push it out? You don't want inventory sitting there going obsolete because then you have spoilage and that's losing money. So are you efficient with getting that inventory in and then pushing that inventory out the door and turning it and converting it into sales and converting it into cash, converting it into profits? The next thing is the days in sales inventory. How long does it take for you? How many days does it take for you to move that inventory? Once it comes in the door, process it and move it right on out. Nowadays we have what they call just in time inventory. You can drop ship inventory. So that is good tools to have. But we want to make sure that we get it in, process it, move it out. The next we have is the profitability ratio. That's your gross margin and your profit margin. I know you guys hear that gross margin and the profit margin till and you're just sick of hearing it. But it's important numbers, you know, especially when you're looking at how you are doing to your industry. The gross margin is after all cost of goods sold have come out. And a lot of folks, you can use that number and compare it to your industry. Example is the restaurant industry. If you're in the restaurant industry, your gross margin should be 33%. If your gross margin is below 33%, people that you're inefficient, you're ineffective in managing your inventory and getting your sales out the door. The profit margin comes after all other direct costs come out. So cost of when you have the gross margin, it is your sales, your revenue, less cost of goods sold. And cost of goods sold are all those things that contributed to you getting to that gross margin. So if you didn't have certain items, inventory items or processes, you wouldn't have this product. So that's contributed to you making that other costs, what we call fixed costs, or things like rent, utilities, things that you could possibly eliminate so that you can keep those dollars in house for profit. So like if you have office rent, could you operate your business without an office? That's the question that you can ask when it comes to certain costs. And that's where profit margin comes in. They ask those questions. How are you the the key question they're asking is how efficient are you with the resources that have been provided to you from shareholders and lenders? So and yourself, customers, how efficient you are with the resources. Other ratios that are used, and these are good for measuring yourself, is the return on assets. It measures how effectively a company can earn a return on its investments in assets. And then you got the return on equity, is how efficient are you with the firm money that is
Hello, everybody. Give me one moment. We're having some technical difficulties. Give me one moment. Hello, everybody. Sorry about that. We do apologize, but we are going to have to end that presentation. Hopefully, we'll be able to work something out. I doubt it if we can actually add it to our schedule since we have it full for the rest of the week. Um, but thank you so much for joining to hear the presentation of State of Your Business with Berenia Hatch. We're still working those issues. And our next presentation will be up at 3 p.m. Central. Again, that's 3 p.m. Central. If you have not gotten your all access ticket, make sure you get your all access ticket so that you can catch all of the replays and have the time to watch them at your leisure. There has been some fantastic speakers already up to this point, and we will continue to bring you some more fantastic speakers coming up further on through this week. Thank you again for your attendance. Appreciate it. And we will see you on our next broadcast. Have a good one.